With its share price already soaring by an incredible 30% since the start of the year, you'd be forgiven for thinking the party is over for Barclays. Most investors would see a jump like that and assume they've missed the boat, that the easy money has already been made. But what if I told you that according to some of the smartest minds in finance, this banking behemoth is still considered undervalued by 10%? How is that even possible? How can a company add billions of pounds to its market value and still be considered on sale by the very people paid to spot these things? This is the paradox at the heart of the modern stock market, a classic battle between the fear of missing out and the disciplined search for true underlying value. Could one of the biggest names on the London Stock Exchange, after a massive rally, still be a hidden bargain? Today, we are pulling back the curtain on Barclays. We will dissect the confusing signals the market is sending, putting its performance under a microscope. We'll explore why one key financial metric suggests Barclays is an absolute steal, while another paints a much less exciting picture. We will also place it in a head-to-head showdown with its biggest rivals, Lloyds Banking Group, HSBC, and NatWest Group, to see who truly reigns supreme in the value department. And, most critically, we will uncover the ambitious strategy that Barclays' leadership believes will fundamentally reshape its profitability and could, if successful, send its stock price into a whole new stratosphere. So, the question is simple but vital. Is Barclays a golden opportunity that's still right for the picking, or is it a value trap, luring in investors just before a fall? Stick around because the answer is far from straightforward and could have a major impact on your portfolio. Let's start by digging into the numbers, the cold hard data that forms the foundation of any investment decision. The first metric we turn to is the price-to-earnings ratio, or PE ratio. In simple terms, this tells you how much you're paying for each pound of the company's profit. It's a quick way to gauge if a stock is cheap or expensive compared to its peers. Barclays currently has a price-to-earnings ratio of 8.2. This means, at the current price, it would take about 8 years of the company's profits to earn back your initial investment. Now, in the Grand League table of the 5 major banks listed on the FTSE 100, this score puts Barclays in joint third place for cheapness. It's not screamingly inexpensive, but it's certainly not outrageously priced either. It's the C-plus student in a class of high achievers and strugglers. It's firmly, and perhaps uninspiringly, in the middle of the pack. If our analysis stopped here, you might just shrug and move on. But this is where the story takes its first dramatic turn. We need to look at another crucial metric, the price-to-book ratio. This one doesn't look at profits, it looks at the company's net worth. Imagine you could buy a house and all its furniture for less than the value of the bricks and mortar alone. That's what the price-to-book ratio shows us. Barclays has a price-to-book ratio of 0.7. This is a stunning figure. It implies that the bank's stock market valuation is a full 30% lower than the actual value of its assets minus its liabilities. You are, in theory, buying £1 worth of the bank's net assets. Its loan books, its buildings, its cash reserves, all after subtracting its debts, for just 70 pence. This is the kind of metric that gets legendary value investors like Warren Buffett excited. It's like finding a multi-billion-pound institution on a Black Friday sale. Let's pause on that for a moment because it's a critically important and frankly bizarre situation. Why would the market do this? A discount to book value often signals deep investor pessimism. It suggests the market doesn't trust the book value itself. Perhaps investors fear that the loans on the books won't be paid back in full, or that there are hidden liabilities lurking in the shadows waiting to pounce. It can be a red flag for concerns about future profitability or the quality of the management team. So, when we see a number like 0.7, we have to ask a crucial question. Is the market a genius, correctly pricing in future problems that aren't yet visible? Or is the market overly pessimistic, creating a once-in-a-decade buying opportunity for those brave enough to go against the grain? On this measure, Barclays does better than almost all of its peers, second only to Standard Chartered. So, on one hand, its profit stream is valued averagely. On the other hand, its physical and financial substance is on a massive discount. This contradiction is at the very heart of the Barclays puzzle. To thicken the plot even further, let's consider what the bank gives back to you directly just for being a shareholder, the dividend. For income investors, this is often the most important number. The dividend yield tells you what percentage of your investment you get back in cash payouts each year. And here, Barclays falters again. Its dividend yield is lower than all of the other major FTSE banks, with the single exception, once again, of Standard Chartered. So you can buy its assets on the cheap, but you shouldn't expect a hefty, market-beating income stream for your trouble. It's a truly mixed and confusing picture. So where do we turn when the numbers themselves seem to argue with one another? We turn to the professionals, the army of brokers and analysts whose entire job is to peer into their crystal balls and forecast where stock prices are headed. According to a consensus of their 12-month price targets, the average forecast for Barclays shares is 382.5 pence. With the stock trading around the current levels, this implies that the shares are currently undervalued by about 10%. A potential 10% upside on a blue-chip banking stock is a very solid prospect. But perhaps the most encouraging sign from the brokers is not what they are saying, but what they are not saying. Among all the major city firms that cover Barclays, not a single one is recommending that their clients sell the stock. Zero. Let's think about the career risk for a professional analyst. Recommending a buy that goes down is unfortunate. Staying neutral is safe. But issuing a sell recommendation is a bold, aggressive move. You are publicly stating that you believe the company is heading for a fall, directly contradicting the company's own narrative and potentially angering its management. Analysts don't make that call lightly. They only do it when they have very high conviction. The fact that an entire chorus of these highly paid, highly scrutinized professionals has looked at all the data, all the risks, and all the opportunities, and not a single one has been willing to plant their flag on sell is an incredibly powerful piece of social proof. It suggests a strong consensus that even if the upside isn't guaranteed, the floor beneath the current share price is perceived as being remarkably solid. This detailed analysis, getting into the weeds of what makes a company tick, is exactly what we aim to deliver every single time. If you're finding this deep dive into the complex world of bank valuations useful, please take a moment to hit that like button. It's a small click for you, but it massively helps our channel reach other curious investors like yourself. Now, let's put Barclays' 10% undervaluation into context by looking at its rivals. Interestingly, the brokers believe NatWest Group is an even bigger bargain, with a potential upside of nearly 17%. At the other end of the spectrum, they think Standard Chartered's shares are actually overpriced by 9%, and that HSBC is more or less fairly valued. Lloyds Banking Group, another major player, is seen as having a modest 5% upside. This comparison places Barclays in a strong position, a clear buy signal for many, but it stops short of crowning it the undisputed king of value in the UK banking sector. The professionals are optimistic, but they see slightly more potential elsewhere. With such a confused backdrop of mixed financial ratios and competing analyst opinions, it's time to zoom out and take a more subjective view. Let's look at the forest, not just the individual trees. The first fundamental truth is that we will always need banks. Despite the rise of smaller fintech challengers, none of them are even close to threatening the deep-rooted dominance of the UK's Big Five. These institutions are woven into the very fabric of the economy. But that doesn't mean the industry is without its perils. The history books are filled with tales of banking crises, spectacular collapses, and government bailouts. The industry is under constant pressure to shore up its balance sheets to meet ever stricter regulatory requirements. And profits can be incredibly volatile. During an economic downturn, the problem of bad loans, customers being unable to pay back what they've borrowed, can escalate rapidly, wiping out profits. However, and this is a crucial point for anyone considering investing today, the UK banking industry appears to be in remarkably good health. This isn't just an opinion, it's the official verdict from the Bank of England. In its latest financial stability report, the central bank declared that the sector is well capitalized, maintains robust liquidity and funding positions, and asset quality remains strong. In plain English, the financial watchdog believes that the major banks, including Barclays, have built fortress-like balance sheets capable of withstanding a significant economic storm. This is not the fragile, over-leveraged banking system we saw heading into the 2008 financial crisis. The foundations are solid. So, with that seal of approval from the highest financial authority in the land, let's bring our focus back to Barclays itself. What is this specific bank doing to supercharge its performance and reward its shareholders? This brings us to the most exciting part of the story, the bank's secret weapon. In its first quarter results for 2025, Barclays reported a staggering 26% increase in earnings per share compared to the previous year. That's not just steady growth, that is a statement of serious intent. But the headline number is just a symptom of a much deeper strategic ambition. The core of the plan is to dramatically increase its return on tangible equity, or ROTE. Think of ROTE as the ultimate measure of a bank's efficiency. It shows how much profit the bank generates for every pound of shareholders' capital invested in the business. In 2024, Barclays' ROTE was 10.5%. The bank has now set a firm target to increase that to over 12% by the end of 2026. But how exactly do they plan to achieve this? This isn't just wishful thinking. It's a concrete operational strategy. It involves a meticulous review of every single part of the bank's vast global operations. It means shifting capital away from less profitable, more volatile areas of its investment bank and pouring it into more stable, higher-return businesses, like its highly successful U.S. consumer credit card division and its UK retail banking arm. It means becoming more disciplined with lending, using data analytics to reduce the risk of bad loans. It also means a relentless focus on operational efficiency, streamlining processes and using technology to cut down on costs without sacrificing service. In essence, the management is promising to perform a kind of corporate alchemy, to take the same massive pool of capital they already have and, through smarter allocation and more efficient operations, generate hundreds of millions of pounds in extra profit. With over £50 billion in tangible equity, a 1.5 percentage point improvement on that gargantuan sum translates into an extra £750 million of pure profit every single year. That is a transformative amount of money. It's cash that can be used to dramatically increase dividend payouts, to buy back vast quantities of its own shares, making the remaining ones more valuable, or to reinvest in the business to fuel even faster growth. This isn't just a minor tweak. It's a strategic overhaul designed to re-engineer the bank's entire profit engine. So let's bring it all home. We started by asking if the Barclays share price, after a 30% surge, can possibly still offer good value. What have we found? We've seen a stock with contradictory valuation metrics, cheap based on its assets, but less appealing based on its immediate income via dividends. We've seen that Citi analysts are optimistic, forecasting a 10% upside, but they see even greater potential in a rival like NatWest. However, we've also established that the entire UK banking sector is standing on a foundation of regulatory-approved strength. And most importantly, we've uncovered a clear, ambitious, and potentially game-changing plan from Barclays to significantly boost its core profitability. Of course, achieving this target is not guaranteed. The economic climate can change, and competition is fierce. But with an experienced chief executive at the helm, a globally recognized brand, and a robust balance sheet, the odds look favorable. The combination of a clear strategic path and a stock that still appears undervalued, even after its recent run, presents a compelling investment case. The risks are undeniable, as they are with any bank, but for investors with a long-term view, the potential reward if Barclays delivers on its promise could be very significant indeed. Unpacking the intricate details of huge, complex companies like Barclays is precisely what we are passionate about. If you want to stay ahead of the curve on the biggest market-moving stories and get in-depth analysis like this delivered straight to your feed, make sure you are subscribed to the channel and have those notifications turned on. You truly won't want to miss what we're investigating.